In the early 20th century, the United States was a wild west of finance. There was no Federal Reserve, no safety net for banks, and no central regulator to step in when things went wrong. The economy was booming, but it was built on a foundation of shaky credit and pure speculation. The trouble began with a failed attempt to corner the stock market for a copper company called United Copper. When the scheme collapsed, the brokerage firm backing it went bankrupt. This triggered a massive chain reaction, as people rushed to their banks to withdraw their cash before the system dried up. By mid-October 1907, the panic was in full swing. One of the largest trusts in New York, the Knickerbocker Trust Company, saw customers lining up around the block to pull out their savings. When the doors closed for the last time, the trust had run out of money, and the panic exploded into a full-scale contagion. As bank after bank faced runs, the New York Stock Exchange was literally minutes away from closing indefinitely. If the exchange went dark, credit would vanish, factories would stop paying workers, and the nation would plummet into a deep, possibly permanent depression. Enter John Pierpont Morgan. At 70 years old, he was the most powerful man in American finance. He wasn't a government official. He was a private citizen who owned one of the largest investment banks in the world. With the government paralyzed, the eyes of the nation turned to his library on Madison Avenue. Morgan summoned the heads of New York's wealthiest banks to his private library. He didn't ask them for their advice. He told them what was going to happen. He locked the doors, effectively holding them hostage until they agreed to pool their resources to provide the liquidity needed to keep the market afloat. He needed millions of dollars on the spot. The other bankers were terrified, but Morgan was relentless. He orchestrated a massive bailout, using his own reputation to guarantee the loans. He acted as the de facto central bank because, quite simply, there was no one else to do the job. But the crisis wasn't over. A major brokerage house, Morey and Schley, was on the brink of collapse because it had borrowed heavily against shares of the Tennessee Coal, Iron and Railroad Company. If that firm failed, it would take down the biggest banks in the country with it. Morgan forced a consolidation. He coerced the United States Steel Corporation, a company he also controlled, to buy up the failing Tennessee coal assets. It was a massive conflict of interest by modern standards, but in 1907, it was the only thing stopping the dominoes from falling. Even the US government got involved. Treasury Secretary George Courtlew deposited roughly $25 million of federal money into the New York banks, effectively providing the fuel Morgan needed to fight the fire. The government was officially following a private banker's lead. By the time the dust settled, the crisis had been averted. The stock market remained open, and the banking system stayed intact. Morgan had saved the economy, but his total control over the situation left many politicians and the public deeply uneasy. The aftermath was clear. The American financial system could not rely on the ego or the generosity of a single man. The panic of 1907 proved that the economy was too big and too interconnected to be left to the whims of private titans. This realization led directly to the creation of the Federal Reserve in 1913. The goal was to establish a permanent, government-backed institution that could provide liquidity during panics, ensuring that no single individual would ever hold that kind of power again. The lesson here is simple: systems built on pure trust and private intervention are fragile. True economic stability requires institutional frameworks that can withstand fear, panic, and the inevitable cycles of the market without relying on the heroics of a single person.